When people from around the world think of businesses in the USA, thoughts are often centered on our financial markets, innovation from private sector, and how businesses and the government are linked through our web of commercial interactions. In this lecture, we will look closely at how companies are organized, how we all interact to facilitate new investments and enforce the rule of law. You will find leaders of companies often come from different backgrounds, bringing unique experiences, and serving to grow the investments of their owners in exciting ways. One of the most unique CEOs of the American business world is Steve Ballmer, former CEO of Microsoft Corporation, who currently finds excitement as the owner of the Clippers basketball team. For this introduction, we turn to Neil Cavuto at Fox Business News.
President-elect Donald Trump on his thank you tour, as he's calling it, showing a lot of passion on stage, something that is not lost on my next guest. Take a look. Steve Ballmer! I always wonder how Steve Ballmer feels when you play that video. I love it, and I'll tell you, Steve, and it's great to have you. It shows unique passion, unique energy. Having covered you for many, many years, I think it's a rare quality in a lot of industries, probably all industries, to see passion. You don't see it that much. How are you?
I'm great. How are you? Good to see you again.
Very good. Donald Trump is certainly an outside-the-box kind of a candidate and an outside-the-box president-elect. I mean, he kind of speaks, off the top of his head, barely uses a prompter. You were that kind of CEO before crowds and annual meetings. I guess there are differences in your approach to things. That's probably an understatement. But a lot of people are saying, Mr. President-elect, it's time to dial it back. It's time to start being more presidential. What do you think?
Well, not for me to give advice to the President of the United States. A whole different thing. I do think it is fun for people who are leaders to both have a chance to be thoughtful and serious, but also kind of, feel it a little bit and show people that you're in and you're excited. And in general, I think that's a good thing for leaders as opposed to, being all stiff and formal. But you don't want to look like a madman who has no real thoughtfulness and sort of contemplative nature.
Yeah, but, and I'm not blowing you smoke, Steve, but you could keep people really glued to their seats in an audience, and that is because you did physically glue them into their seats. But no, I'm kidding. But that the idea was, you're trying to jazz a crowd. You're trying to get them into what you're talking about, whether you're talking about developers or Clippers fans. I mean, there's not much difference here keeping them engaged, right?
No, and I think it is really important. When you have a group of people in front of you, they've come, yes, to hear your message, but they also kind of want to be there. They want to be excited. They want to be inspired. And you are right. You bring people to a computer conference, and you want them not only to understand what you're saying, you want them to follow you. You want them to be enthusiastic. We get guys to Clipper games. The number one thing I care about, actually, on the business side of the Clips is how loud we can get our fans bumping and thumping during the games, because I think it's exciting for the fan, and, by the way, it's great for the team.
And it's sold out every game since you've had them, so you're doing something right. Let's talk a little bit about now in this post-election environment. I have no idea who you supported or voted for. I know your wife, Connie Ballmer, had donated to Hillary Clinton earlier in the campaign year. How's she faring now?
Well, I mean, she and I both actually were focused in on our issues. Yeah. And, for me, it's sort of like when you're on Microsoft. You're not, as a CEO of a company, you're not a Democrat, you're not a Republican, not at least in your business. You're all about Microsoft. You're all about whatever company you lead. The issue we are very focused in on is how do kids who are born in tough circumstances get a shot at the American dream? And there literally are communities in this country where 50% of the kids are, the probability rather is 50% the kids are not going to do any better than their parents. And I just think, people ought to deserve a better shot, whether we have Republicans in office or Democrats in office. We're working with everybody on that particular goal.
That's not too shabby. You know, I wonder what you then make of the move the president-elect made to save these 1,100 or so jobs at Carrier. There are a lot of pure free market capitalists, Steve, who said, be careful what you wish for, Mr. President-elect, because you're going to have to do that for everybody, and you're choosing winners and losers, the same thing you criticized Barack Obama for doing when he was trying to build and support the solar and wind energy and all of those guys, Cylinder et al. What do you make of that a president, let alone a president-elect, shouldn't be doing this kind of stuff?
Well, I think there's sort of two aspects, and, you know, again, I don't sit in the president's seat, and I wouldn't dare to say. If I take a look, I have another project I'm working on called USA Facts. By early next year, we hope to be able to actually, after 2 years of study, be able to simply tell people, other people other than me, we're trying to learn, where does government money come in, where does it go out, and what impact really does government have? And I've developed a point of view that says there's very little the government can actually do to stimulate the economy in the long run. Yes, interest rates in the short run, yes, spending in the short run, but those things, they blip up, they blip down. There are a few things, and trade is one of them, and you know, the country has to decide on how it feels about open border for trade or less open border. This president will decide, but at the end of the day, I think the inexorable kind of advance of innovation in the private sector is what's going to stimulate jobs in America, maybe jobs abroad too, but jobs here in America.
Thank you, Neil Cavuto and Steve Ballmer, for this energetic insight into the business world of positive thinking and energetic searches for solutions to business and social challenges. We will now take this energy to explore how businesses are organized and financed, and to whom they provide benefits to share information with. In the United States, there are 4 main categories firms are organized under. A sole proprietorship is a firm owned by a single individual and not organized as a corporation. This is the business you might have started as you mowed lawns, sat as babysitter, or sold firewood through. It is the name you put to your services, and it was a sole proprietorship. A partnership is a firm owned jointly by 2 or more persons and still not organized as a corporation. Most law and accounting firms are partnerships. Most large firms are organized as corporations. A corporation is a legal form of business that provides owners with protection from losing more than their investment should the business fail. There are several flavors of corporations, such as the recognized business structure of most companies like Microsoft Inc., Walmart Inc., and ExxonMobil Inc. These corporations have thousands of shareholders and are managed by a team of executives. There are closely held corporations termed S-corporation, meaning a small business corporation generally with fewer than 100 domestic shareholders and only 1 class of stock. A fairly new business organization format is the limited liability company, an LLC, which carries the protections against liability of owners when they act on behalf of the company, but forfeits the ability to raise funds by issuing stocks or selling bonds. In 1977, when the state of Wyoming first passed legislation allowing a new type of company called a limited liability company, hardly anyone noticed. Today, over 2/3 of all new companies formed are LLCs. It is a business structure that combines the pass-through taxation of a partnership or sole proprietorship with the limited liability of a corporation. An LLC is not a corporation. It is a legal form of a company that provides limited liability to its owners in many jurisdictions. Now, we'll take a look at each of these business forms. The owners of sole proprietorships and partnerships have unlimited liability, which means that there is no legal distinction between the personal assets of the owners and the assets of the firm. An asset is anything of value owned by a person or firm, and this includes the owner's investments, savings accounts, and their home. Beginning in the early 19th century, state legislatures began to pass laws that allowed firms to be organized as corporations, and more recently as LLCs. Under the corporate and LLC forms of business, the owners have limited liability. Limited liability is the legal provision that shields owners of a corporation or LLC from losing more than they have invested in the firm. The personal assets of the owners of the firm are not affected if the firm fails. Limited liability makes it possible for corporations to raise funds by issuing shares of stock to many investors. Corporate profits are taxed twice, once at the corporate level and again when investors receive their share of corporate profits. Corporations are generally larger than sole proprietorships and partnerships and more difficult to organize and run. LLCs cannot issue stocks or bonds to raise funds. LLCs are generally about the size of sole proprietorships and partnerships, although none of the business structures limit the size of the organization. Some businesses make their structure using obvious reasons. For instance, a company making a commodity that puts them at potential risk of liability to food poisoning, like a meat canner, or device malfunction that could harm someone, like automobiles, may want to adopt a business form that delivers liability protection. Other businesses that perform services like house cleaning or painting, art galleries or bookstores, will operate nicely as sole proprietorships or partnerships. Although the cost of forming the LLC are similar to the cost of forming a sole proprietorship or partnership, the cost of forming the corporation requires licensing and paperwork at initiation and quarterly to report to the state of incorporation tax offices and corporate records offices. Taxes for the corporation are handled different from the other forms. Revenue to corporations are taxed first to the company and second to the shareholders. They are taxed twice. The corporate tax rates have been higher historically than private individuals are taxed. But corporations are the only business form that can issue shares of ownership through the stock market, and the only form that can issue bonds on the open market to raise funds. We will circle back to this topic in a few minutes. Recognizing these three types of firms in the United States as sole proprietorships, partnerships, and corporations. Panel A shows that only 18% of all firms are corporations. Yet, as panels B and C show, corporations account for the majority of the revenue and profits earned by all firms. Even though big corporations generate most of the financial activity in the USA, small businesses bring the majority of new jobs and represent creative innovation throughout the economy. All businesses struggle to keep employees engaged during economic downturns, and smaller businesses are often more resilient during slowdowns. But they are not immune to the effects of the business cycles. I give most attention to these performance graphs recognizing how the larger businesses have been able to grow more during expansionary periods than did the medium and smaller sized businesses in the same economic environments. When you picture a business, you think of the founder of the company as someone who owns the business and is involved in the day-to-day operations, someone who makes decisions from the ground up. Then the company grows, incorporates, hires more people, and expands operations, and an evolving business structure is adopted and deployed. Right there, you have introduced the separation of ownership from control. This is a situation in a corporation in which the top management, rather than the shareholders, controls the day-to-day operations. The top management of a large corporation does not generally own a large share of the firm's stock, so there is a separation of ownership from control, a problem sometimes caused by an agent pursuing personal interests rather than the interests of the principal who hired the new talent. Corporations are legally owned by their shareholders, the owners of the corporation's stock. Shareholders do not manage the firm directly. Instead, they elect a board of directors to represent their interests. The board of directors appoints a chief executive officer, the CEO, to run day-to-day operations and may appoint other top management. Managers may serve on the board of directors. They are referred to as inside directors. Outside directors are directors who do not have a management role in the firm. Corporate governance is the way in which a corporation is structured and the effect that structure has on the corporation's behavior. Separation of management from ownership benefits the corporation, but can lead to a potential problem from the principal-agent complex. To lessen these conflicts of interest, many firms structure the agent's benefit package to include transfer of corporate stock shares. This serves to anchor the CEO in the same boat as all other shareholders. To earn a profit, a firm must raise funds to pay for its operations. If a small business is successful and the owner decides to expand, it can obtain funds in three ways. First, the firm can reinvest its profits, called retained earnings. Second, the firm can take on one or more partners who invest in the firm. Third, the owner can borrow funds from relatives, friends, or a bank. Unless firms rely on retained earnings, they must obtain the external funds they need from others. The financial system transfers funds from savers to borrowers, directly through financial markets or indirectly through financial intermediaries such as banks. Firms raise external funds in two ways. Indirect finance refers to a flow of funds from savers to borrowers through financial intermediaries such as banks. Intermediaries raise funds from savers and lend to firms and other borrowers. The second way to acquire external funds is through financial markets. Direct finance refers to a flow of funds from savers to firms through financial markets such as the New York Stock Exchange. This option is only available for corporations, as other business forms cannot create stock to sell to investors. Bonds are also only an option for corporations. Together, stocks and bonds are known as financial securities. A financial security is a document that states the terms under which funds have passed from the buyer to the borrower. A bond is a financial security that represents a promise to repay a fixed amount of funds. The interest rate is the cost of borrowing funds, usually expressed as a percentage of the amount borrowed. The interest rate on the bond is equal to the coupon payment, which is an interest payment on a bond, divided by the amount borrowed. The corporation will set the term of the bond and the coupon rate, which is the rate of return the investor will receive if they purchase the bond. The corporation wants to attract investors, so they make the term long and the rate high. But they do not want to commit to it so much that it becomes impossible to honor the bond. These are stated as an annual payment. For example, if the annual payment on a $1,000 bond is $40, then the interest rate is $40 divided by $1,000, which equals 0.04 or 4%. Many bonds that corporations issue have maturities of 30 years. The interest rate that borrower selling a bond has to pay depends on how likely bond buyers think it is that the bond seller is to default. The higher the default risk on the bond, the higher the interest rate. You will discover that in the world of corporate finance, the corporation is legally bound to honor bond payments before dividend payments can be made. A stock is a financial security that represents partial ownership of a firm. When a corporation sells stock, it is increasing its financial capital by bringing additional owners into the firm. A shareholder is entitled to a share of the corporation's profits. Corporations generally keep some profits, known as retained earnings, to finance expansion. The remaining profits are paid to shareholders. Dividends are payments made by a corporation to its shareholders. A corporation must make promised payments to bondholders before it can make dividend payments to shareholders. Most buying and selling of stocks and bonds involves investors reselling existing stocks and bonds. There is no single place where stocks and bonds are bought and sold. Some trading takes place in buildings called exchanges, but computer technology has spread the trading of stocks and bonds to dealers outside of exchanges. Changes in the prices of stocks and bonds and other securities reflect investors' future expectations. A bond that was issued in the past may have its price increase or decrease, depending on whether the coupon payments being offered on newly issued bonds are higher or lower than on existing bonds. The price of a bond will also be affected by changes in default risk, or investors' perceptions of the issuing firm's ability or inability to make coupon payments. Think about investors who want to participate in business ownership and purchase shares of stock in growing or new businesses. These people will have a super difficult time investigating each and every company to discover details making their risk versus benefit profile look clear. In steps, credit rating agencies. These agencies have ability to discover and report facts about corporations that those companies are obligated to report. Obligations in this case are legally binding on corporations. The reports by these agencies are used to qualify the value of bonds issued by those companies and governments. A conflict of interest was mostly always present, but not realized until the mid-2000s. It came with the mortgage-backed securities scandal that happened when mortgage-backed bonds were rated at low risk and high value even as the assets they were based on tanked. This was the case of the credit rating agencies receiving payment from the firms having a stake in the results reported. A financial stake was anchored to making the mortgage-backed securities a valuable asset. When it collapsed, everyone lost their chair in the musical go-around leading to the Great Recession. Think back to September 2016, as Samsung Electronics was splashed in the headlines with cell phone problems of batteries catching fire as they charged. Even airlines forbid these phones on flights for caution against fire during the flight. Samsung announced a replacement battery to fix the problem. Then in October 2016, the replacement batteries caught fire, and Samsung, instead of accepting responsibility, blamed a battery supplier. For some investors, Samsung was a write-off. By November 2016, the company structured new product releases, reset pricing levels, targeted new markets, and in early January 2017, they discontinued the Galaxy Note 7 line of products, and investors watched as stock prices climbed. Oftentimes, stock performance is driven not only by the book price reported through the reporting agencies, but by the happenstance events of technologies and investor preferences. The performance of the U.S. stock market is often measured by market indices, which are averages of stock prices. The three most important indexes are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. During the period from 1996 to 2013, the three indexes followed similar patterns, rising when the U.S. economy was expanding and falling when the economy was in recession. Note that in all three panels, the vertical axes do not start at zero. As 2017 turned the calendar page, the Dow Jones Industrial Average peaked for the first time ever above 20,000, giving many of us the indication that the U.S. economy is headed into a fresh expansionary period. Before a corporation can sell new issues of stocks or bonds, it must provide investors with information about its finances. In the United States, the Securities and Exchange Commission, the SEC, requires publicly owned firms to report their performance according to generally accepted accounting principles. Some private companies, for example, Moody's Investor Services and Standard & Poor's, collect information from businesses and sell it to subscribers. Investors and the managers of firms need information regarding the firm's revenues and costs, as well as information regarding the value of the property and other assets the firm owns and the firm's debts or other liabilities it owes to others. A liability is anything owed by a person or a firm. The information investors need to know to decide whether to buy the firm's stocks or bonds is contained in the firm's financial statements. A firm's income statement is a financial statement that shows a firm's revenues, costs, and profit over a period of time. A balance sheet is a financial statement that sums up the firm's financial position on a particular day, usually at the end of a quarter or a year. A balance sheet summarizes a firm's assets and liabilities. Subtracting the value of a firm's liabilities from the value of its assets leaves its net worth. Net worth is what the firm's owners would be left with if the firm were closed, its assets sold, and its liabilities paid off. Accounting profit is a firm's income measured as revenue minus operating expenses and taxes paid. This is the metric used for taxation purposes. Economic profit is the firm's revenue minus all of its implicit and explicit costs. Because economic profit takes into account all costs, it provides a better indication than accounting profit of how successful a firm is. Do not allow the inconsistency of these two statements of profit to confuse you. Accounting profits are aimed to explain and articulate the status of investments and tax liabilities. Economic profits describe how the business is performing in the economy, giving opportunities taken and those avoided. It uses opportunity cost options, implicit and explicit, to evaluate performance. Economists always measure cost as opportunity cost. Opportunity cost is the highest valued alternative that must be given up to engage in an activity. An explicit cost is a cost that involves spending money. An implicit cost is the non-monetary opportunity cost. The firm's most important implicit cost is the opportunity cost to investors of the funds they have invested in the firm. The minimum amount that investors must earn on the funds they invest, expressed as a percentage of the funds invested, is called a normal rate of return. If a firm fails to provide at least a normal rate of return, it will not remain in business over the long run.
The crisis of credit, visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy Treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe, AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% Treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
Firms disclose financial statements in periodic filings to the SEC and in matching annual reports to stockholders. The management of a firm has two reasons to attract investors and keep the firm's stock price high. First, a higher stock price increases the funds the firm can raise when it sells a given amount of stock. Second, to reduce the principal agent problem, boards of directors often tie the salaries of top managers to the firm's stock price. However, problems that surfaced during the early 2000s revealed that some managers inflated profits and hid liabilities. At other firms, managers took on more risk than they disclosed to investors. They complied with generally accepted accounting practices, but did not recognize implicit or explicit costs of the choices they made. In the early 2000s, top managers at some firms, such as Enron and WorldCom, falsified their firm's financial statements to mislead investors about how profitable they were. The federal government regulates how financial statements are prepared, but cannot guarantee the accuracy of their statements. To guard against future scandals, the Sarbanes-Oxley Act of 2002 was enacted, which requires CEOs to personally certify the accuracy of financial statements. Most observers acknowledge that the Sarbanes-Oxley Act increased confidence in the U.S. corporate governance system, though problems during 2007 to 2009 at financial firms again raised questions of whether corporations were adequately disclosing information to investors. It seems transparency has several shades of clarity. The U.S. economy suffered the stiffest financial crisis since the Great Depression from 2007 through 2009. Looking back to the 1970s, financial institutions began securitizing mortgage loans. Mortgage-backed securities are similar to bonds. Buyers receive regular interest payments, which in this case come from the payments made on the original mortgage loans. At first, the securitization process was carried out by the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. Fannie Mae and Freddie Mac would buy mortgages granted to borrowers and bundle them into securities that were sold to investors. In the 1990s, private financial firms began securitizing mortgages. By the early 2000s, many mortgages were granted to subprime borrowers, borrowers with flawed credit histories, and Alt-A borrowers, who failed to document that their incomes were high enough to afford their mortgages. Housing prices soared during the late stages of the expansionary period, but began falling by 2006. By 2007, many borrowers began to default on their mortgages, and many financial institutions started to suffer heavy losses. Many investors complained that they weren't aware of how risky some of the assets on the balance sheets of financial firms were. In fall of 2008, Fannie Mae and Freddie Mac were brought under control of the government. The Wall Street Reform and Consumer Protection Act, the infamous Dodd-Frank Act, is legislation passed during 2010 that was intended to reform regulation of the financial system. The act created the Consumer Financial Protection Bureau to write rules and protect consumers in their borrowing and investing activities. The act also established the Financial Stability Oversight Council, which is intended to identify and act on risks to the financial system. Again, looking backwards to the 1990s, private investment banks began to securitize mortgages. Investment banks had traditionally concentrated on providing advice to corporations selling stocks and bonds, and on underwriting the issuance of stocks and bonds. To address the risks of investment banking, Congress passed the Glass-Steagall Act in 1933 to prevent firms from being both commercial banks and investment banks. This was intended to prevent a conflict of interest. Congress repealed Glass-Steagall Act in 1999. Many of the best-known financial firms remained investment banks. Mortgage-backed securities originated by investment banks were sold mostly to investors, but investment banks retained some of the securities as investments. When the prices of the securities declined in 2007 and 2008, the investment banks suffered heavy losses. Lehman Brothers declared bankruptcy. Merrill Lynch and Bear Stearns were sold to commercial banks, and Goldman Sachs and Morgan Stanley became bank holding companies. The era of the large Wall Street investment banks appeared to have ended. Traditionally, Wall Street investment banks had been originated as partnerships, but by 2000, all had become publicly traded corporations. With a publicly traded corporation, the principal-agent problem can be severe. Some economists believe that the financial crisis may not have occurred if investment banks had remained partnerships. Let's look closer at the situation of one of these entities, Enron.
Enron used to be the 7th largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
It's been 2.5 months since Bernard L. Madoff was picked up and charged with what's believed to be the largest financial fraud in history. Yet we still don't know much more about the alleged $50 billion scam than what Madoff initially told the FBI agents who arrested him. There are still no indictments as federal prosecutors continue to unravel the case and to try and figure out exactly what happened and who all was involved. But the proof that it happened can be found in the ruined lives of thousands of victims. The one person who knows the most and is willing to talk is Harry Markopolos, the man who figured out Madoff's scheme before anyone else. He sat down with us for his only television interview. Until a few months ago, Harry Markopolos was an obscure financial analyst and mildly eccentric fraud investigator from Boston, who most people would never notice on the street.
My modern Greek hero, how you doing?
But today he enjoys an almost heroic status, pursued by journalists and movie producers and honored by colleagues as the man who went to the Securities and Exchange Commission and blew the whistle on Bernie Madoff and his $50 billion fraud.
Thank you. Thank you. Please take your seats.
But he seems uncomfortable with all the attention and knows that he is no hero.
I stand before you, a $50 billion failure.
How many times did you send material to the SEC?
May 2000, October 2001, October, November, and December 2005, then again June 2007, and finally April 2008. So 5 separate SEC submissions.
And in spite of all of the things that you did, it still ended up in disaster.
There's nothing to be proud about in this case. I feel horrible about the result. It's been a total disaster for the victims.
It began a decade ago when Markopolos was working for a Boston investment firm. His boss told him that Bernard Madoff, a former chairman of the NASDAQ stock exchange, was running a huge unregistered hedge fund that was producing incredible returns. He wanted Harry to reverse engineer its trading strategy and revenue streams so that the firm could duplicate Madoff's results.
He had the patina of being a respected citizen, one of the most successful businessmen in New York, and certainly one of the most powerful men on Wall Street. You would never suspect him of fraud unless you knew the math.
So, I mean, you're like a math guy, right?
I've taken all the calculus courses from integral calculus to differential calculus. as well as linear algebra, and statistics, both normal and non-normal.
How long did it take you to figure out that there was something wrong?
It took me 5 minutes to know that it was a fraud. It took me another almost 4 hours of mathematical modeling to prove that it was a fraud.
What were the things that caught your attention?
It was the performance line. As we know, that markets go up and down, and his only went up. He had very few down months. Only 4% of the months were down months, and that would be equivalent to a baseball player in the major leagues batting .960 for a year. Clearly impossible. You would suspect cheating immediately.
Maybe he was just good.
No one's that good.
Harry said there were only two plausible explanations. Either Madoff was using insider information to rack up huge profits, or he was running a giant Ponzi scheme.
So either way, he was doing something illegal.
Either way, I knew he was going to go to prison.
In May of 2000, Markopolos took his suspicions about Bernie Madoff to the Boston office of the Securities and Exchange Commission.
Did you have any financial motive?
Yes. He was a competitor of mine in 2000 to 2004 while I was still in the industry. And when someone's competing on your playing field, who's a dirty player, you want him tossed off the field.
He also thought he might be eligible for a sizable reward if the fraud involved insider trading, but that turned out not to be the case.
In your first letter to the SEC back in 2000, you're a little tentative. You say, look, I have no smoking gun.
In 2000, it was more theoretical. In 2001, it was a little bit more real. By 2005, I had 29 red flags that you just couldn't miss on. By 2005, the degree of certainty was approaching 100%.
Over time, and with some simple math calculations, Markopolos concluded that for Madoff to execute the trading strategy he said he was using, he would have had to buy more options on the Chicago Options Exchange than actually existed. Yet he says no one he spoke to there remembered making a single trade with Bernie Madoff's fund.
I would talk to the people I had trading relationships with and ask, did you have a trading relationship with Mr. Bernard Madoff? And they all said, no, we don't think he's for real.
Could you find anybody?
I found no one that ever traded with Mr. Madoff, and I traded with the largest equity derivatives firms in the world.
And that's because Madoff's investment fund never actually made any trades, at least going back to 1993 and probably further, a fact confirmed last week at a meeting of Madoff investors by the trustee charged with liquidating his assets. No one knew the depth of the fraud, but a lot of people had questions.
Who else figured this out besides you?
I would say that hundreds of people suspected something was amiss with the Madoff operation. If you look at who the victims were not, you'll notice that the major firms on Wall Street had no money with Mr. Madoff.
I mean, you write in this is the letter, I'm quoting from the letter to the Securities and Exchange Commission, red flag number 20. Madoff is suspected of being a fraud by some of the world's largest, most sophisticated financial services firms. And then you list some of the firms.
Yes, I do.
The biggest firms on Wall Street, and conversations with people high up in those firms.
That is correct. And the SEC ignored that.
Did they call any of these people?
All the SEC had to do was pick up the phone. They never did.
If you had executives at the biggest investment houses in Wall Street that knew something was wrong, why do you think they didn't go to the SEC?
Because people in glass houses don't throw stones, and self-regulation on Wall Street doesn't work.
In January 2006, the New York office of the Securities and Exchange Commission finally opened a case file to look into Harry's allegations about Bernie Madoff. Despite uncovering evidence that Madoff had misled them about his investment activities, the SEC closed the case 11 months later without ever opening a formal investigation. The staff said there was no evidence of fraud.
What I found out from my dealings with the SEC over 8.5 years is that their people are totally untrained in finance, they're unschooled, most of them are just merely lawyers without any financial industry experience.
Well, if the people there aren't trained in securities work, what are they trained in?
How to look at pieces of paper that the securities laws require. They can check every piece of paper perfectly and find misdemeanors, and they'll miss all the financial felonies that are occurring because they never look there. Even when pointed to fraud, they're incapable of finding fraud.
No one at the SEC would talk to us on the record about Harry Markopolos' allegations, but one person who seemed to have had a high opinion of the agency was Bernie Madoff.
I'm very close with the regulator, so I'm not trying to say that they can't, that what they do is bad. As a matter of fact, my niece just married one.
Besides his niece's husband, who no longer works at the SEC, Madoff has had long-standing ties to the agency and has been called upon to give advice. At this 2007 meeting of a nonprofit group called the Philoctetes Center, Madoff seemed to think the SEC was doing a great job.
In today's regulatory environment, it's virtually impossible to violate rules. And this is something that the public really doesn't understand. But it's impossible for you to for a violation to go undetected. Certainly not for a considerable period of time.
But don't try and tell that to the Philoctetes Center today. Its main benefactor, the Betty and Norman Levy Foundation, was fully invested in Madoff, one of dozens of charitable organizations that have been devastated or wiped out. Madoff's customer list, single-spaced with small type, is 162 pages long, with victims running the gamut from Hollywood royalty to a carpenter's pension fund in Syracuse, New York. Shelley Ludlow has been forced to put her mother in a Medicaid-assisted living facility while she packed up their apartment to move in with a friend, all because of Bernie Madoff.
Our whole lives were turned upside down by this man that sits in his penthouse and smirks.
The same day last week, 70 miles away, Len and Marge Forrest were leaving their house that they had just sold in Setauket, Long Island, and were preparing to drive to South Florida to sell their home there. They had their money with Bernie Madoff for 30 years and lost an 8-figure family fortune 2 days before his 80th birthday.
Do you have any money to live on?
Enough, I would say, for 60 days.
Do you know other people who are in the same situation?
Oh, yes. We have a lot. Unfortunately, and I think probably the thing that tears me up more than anything is the fact that I recommended Madoff to a number of people. And they lost their money, and I'll never stop feeling responsible for that. They were all close family and friends.
Len Forrest and his friends thought they were part of a small, exclusive group of investors lucky enough to have a connection with Bernie Madoff. And because they thought they were making 12% a year, they weren't inclined to ask a lot of questions. Harry Markopoulos called it the classic affinity scam.
An affinity scam is when you prey on groups that are similar in nature to yourself. So I'm Greek. If I was going to run an affinity scam, I would run it on the Greek-American community here. Bernie was Jewish, so he ran it on the Jewish community in the United States, but that wouldn't get him enough customers because he always needed new money to keep the scheme going.
Over time, Madoff extended his reach from New York to Palm Beach, where he enlisted hundreds of wealthy clients, many of them recruited from his own country clubs. And he also made connections that gave him entree to Europe and the hedge fund capital of America, Greenwich, Connecticut.
It was here that Bernie Madoff made some of his biggest deals with large investment firms that were willing to feed him billions of dollars of their clients' money to manage. And in return, Bernie Madoff agreed to pay these so-called feeder funds a fortune in annual fees. The largest of the feeder funds was the Fairfield Greenwich Group. How much money did Fairfield make off Bernie Madoff every year?
Hundreds of millions of dollars.
If you're a feeder fund, what are you supposed to do for those hundreds of millions of dollars?
You're supposed to identify the world's best hedge fund managers and invest only in them, and you're supposed to make sure they're not running Ponzi schemes.
The real steroids here were the feeder funds. That's what made it an international Ponzi scheme.
Attorney David Boies is one of the most prominent lawyers in the country and is representing Fairfield Greenwich investors who lost nearly $7 billion when Madoff went under. They're suing the firm for gross negligence, claiming it failed to investigate Madoff thoroughly or monitor his activities as it promised to do in its marketing materials.
Analysis of portfolio composition, portfolio stress testing, risk management, asset verification. Do you think that really happened?
No, we know it didn't happen because we know all they did was turn the money over to Bernie Madoff, and they did that for 20 years.
They did nothing.
They essentially did nothing except lose their investors' money and enjoy very luxurious lifestyles from the money they took out.
Walter Knoll, one of the founding partners of Fairfield Greenwich, declined to talk to us and has reportedly been lying low with his wife at their compound on the private island of Mystique. But in a statement to 60 Minutes, his firm said that it too was a victim of Bernie Madoff, that it had placed too much trust in his then impeccable reputation, and in the fact that there had been multiple reviews of Madoff by the SEC.
What do you have to say for yourself?
In the end, Harry Markopolos had been right about Bernie Madoff. He will be going to prison, but not because of anything that Harry or the SEC did. In a bad economy, Madoff's lies simply collapsed under their own weight.
No one was investigating Mr. Madoff at the end.
So he turned himself in before anybody in a position of authority began a serious investigation.
That's typically how the SEC does it. They come in after the crime has been committed. They toe tag the victims, count the bodies, and try to figure out who the crooks were after the fact, which does none of us any good.
For more video of Bernie Madoff in his own words, go to 60minutes.com.
Forwarding now to more recent events, we can look into familiar names like Facebook. The performance of the U.S. stock market is often measured by market indices, which are average stock prices. The three most important indices are the Dow Jones Industrial Average, the S&P 500, and the Nasdaq. During the period from 1996 to 2013, the three indices followed similar patterns, rising when the U.S. economy was expanding and falling when the economy was in recession. We are going to take a short route off our textbook guidance to use some tools I brought to you at the beginning of this semester from Fred. As economists, we are seated in position to discover what interest rates apply to our decisions. This is the detective part of our persona. We can discover what interest rates have been present in our economy for the past month, quarter, year, decade, or longer. We can step into Fred and look at the Producer Price Index to see what businesses have experienced, and at the Consumer Price Index to find the same for consumers. The Bureau of Labor Statistics collects these data and hundreds of others on a daily basis to release monthly statistics about the performance of various sectors in our economy. It is based on the cost of a standard set of goods and services in two baskets, one for producers and the other for consumers. As the cost of goods in this non-changing basket changes, the index values change. Changes in the index cost represents the purchasing power of the US dollar. We will use that purchasing power to reveal the time value of money. These values are reported monthly in each index. Although these indices are not the sole source of determining when the economy is in recession, they clearly demonstrate how factors are interrelated to explain the performance of things like inflation, recession, and expansion. From my standpoint, I have been most impressed by the people at the BLS, as I have called their Washington, D.C. office to have a specialist actually answer the phone and engage with me in discussions. I have called their regional office in San Francisco to arrange specialists to address industry and college groups. BLS specialists investigate data and provide me with answers. In one interaction, I called to search data on a sector they stopped reporting about in the current month. The response was to refresh the data collection to continue reporting. They were unaware we were actually using those data and adjusted midstream to accommodate the needs of an industry sector. If you own shares of a stock or bond, you will receive payments in the form of dividends or coupons over a number of years. Most people value funds they already have more highly than funds they will receive in the future. Present value is the value in today's dollars of funds to be paid or received in the future. Putting pencil to paper, we discover that investing $1,000 today at a rate of return of 10% for 1 year, put through the future value of a single sum, is worth $1,100 in 1 year. Now, flip that around. To assume you're willing to receive $1,100 in 1 year based on your investment of $1,000 today. In this case, you're earning 10% on the funds you have loaned. Economists would say that $1,000 today is equivalent to $1,100 to receive 1 year in the future. We can take this exact approach to apply it not just to 1 year of investing, but a series of 1 initial payment plus 4 additional payments. We add each payment placed in time to discover a present value of a terminating annual series. We continue to use the 10% rate of return to see that each annual payment through time is worth less in current terms than the previous. We call this an expression of the time value of money. We have used a 10% interest rate in these examples. It is super simple for this math, but we need to consider different rates based on your personal impatience factors. When you are very impatient for a return on your money, your interest rate for discounting will be high. Conversely, a lower rate of return will explain your patient nature. Now, I introduce you to a strategy you can use to discover what the growth rate of the U.S. economy has been. I can look at the Producer Price Index rate of change within the most recent expansionary phase between January 2002 and December 2007. By selecting the index numbers from the starting and ending points and inserting them into this formula, we calculate what the rate of inflation was during this period. This rate can be calculated between any 2 points along this series, for a few months, several years, or even for decades. Over this 6-year period, the rate of business inflation was 5.64% per year. The same approach can be made while using the Consumer Price Index to discover a representation of the inflation rate of consumers, the average person. Here we find the CPI in January 2000 at 168.8 and the July 2008 CPI of 219.9. Filtering it through your rate calculator, this discount rate is 2.93% per year over this 9.17-year period. The use of inflation and discount rates is very important to understanding the time value of money. At the fundamental level, we consider money in our hands today more valuable than the same amount of money delivered in the future. The longer money delivery is delayed, the lower the present value of that money is. Value is determined both by the time of delay and the rate of decay. In this case, decay is the inflation rate. More to the point, when we are in a general economic growth cycle, an expansionary period, costs will rise each year. This is the reality of inflation. Inflation eats away the value of money. 50 years ago, $100 could buy food for a family of 4 to last a month. Today, one bag of the same groceries costs $100, and a month of food for a family of 4 costs closer to $500 and more. This is the effect of inflation. I use a combination of inflation and discount rate, specific to the investor of consideration, to consider an overall adjustment rate. Although this rate is specific to each investor, I recommend starting with the rate of inflation expected for the near-term period. We just looked at the PPI of 5.64% and we'll use it. Then take half this rate to apply it to your personal discount rate, here at 2.82%. We use these in combination. Creating the overall adjustment rate, we just use a cross-product multiplier of F and R. We want to consider the present value of a single sum, V sub 0, as $1,000 received in 10 years. Our estimate for this rate was 9.17 years, but we can apply this rate to any term, short or long. The present value of $1,000 received in 10 years at this 8.62% adjustment rate is $437. This includes the decay value caused by the expected rate of inflation and the impatience factor of the investor. Consider this. What if the rate of inflation was expected not at 5.64%, but instead at 3%? With the discount rate also reducing to half of the inflation rate, the new adjustment factor would be 4.54%, and that $1,000 in 10 years would be worth $641 today. Notice how the lower adjustment factor increases the discounted value in present-day terms. Try it in reverse. What if inflation is expected to climb to 8%? No, really, give it a spin. You will want to be able to do this for this class and others. You will use it in your personal life and in business. This super fast demonstration of inflation and discount rates has meaning for you. Not only as an entrepreneur or student of business, it applies to your decisions made as a consumer. You might be borrowing money right now to pay for college. You may want to purchase a vehicle. You will be fully engaged in money matters, and you need to be able to discover for yourself your personal time value of money. Your personal rate will change through time. I use the PPI and the CPI to measure what the economy has done in the long-term past and short-term past. I use these rates as a proxy, meaning they are not perfect predictors of what will be inflation, but I can make stronger estimates about the future using these. As I have worked with clients, I have found some people who have strong opinions about what the expected rates of return will be in their markets. I find those who do not follow indices such as these often struggle to release what has been realized in the past. It includes such perceptions of an expected discount rate of 7% seen in the 1970s, when inflation was above 15%. But when we are experiencing 1% inflation we saw from 2010 through 2016, the 7% discount rate is not in line with current realities. The time value of money is not static. Now you have some no-cost tools to assist you when realizing what you are up against. We have looked only at the present value of a single sum, future value of a single sum, and one instance of the present value of a terminating annual series. I made this poster in the 1980s when I first started studying economics and finance in the forest management sector. I have updated it since then and added this dichotomous decision tree framework. Follow the path through each decision point to find the formula that will solve your finance questions. Here, I shows the combination of inflation and discount, the cross multiplier. Experiment with these and find uses for your finance questions, using economic tools to make meaningful projections. These are not on quizzes or exams in this class. They are given to you for your personal edification and bonus. Make it count. Bring these concepts back to the analysis of bonds in the corporate business world. You consider buying a $1,000 bond with $80 coupon payments in 2018 and 19 with a 2019 maturity date. Pushing it through with the 10% interest rate, you find a $965.29 value. But what if your rate is not 10%, but instead 5%? Using the same approach, you determined the bond value to be $1,056. The lower your overall discount rate, the higher the discounted value will be. As we convert to stock values, consider there is no sunset date as there is with a bond. You are the owner of the company, or at least a small part of the company, and you will receive the corporate dividends as long as the company delivers. The bond payments are agreed when you purchase the bond. They are set. Stock dividends are based on the performance of the company, so they go up, they go down. They are not set in advance. You want to calculate the value of purchasing corporate stock that is paying a dividend of $50 per year with an expected growth rate of 2.5% per year. Using the 4.545% loaded discount rate and inflation rate calculated several minutes ago, you divide the annual dividend by the difference of your personal discount rate minus the anticipated rate of growth to find the stock value of $2,450, given these specific assumptions. Income statements and balance sheets are part of the bread and butter of accounting operations because they give a snapshot in time of a company's performance. With these reports delivered through time, an investor, business manager, or regulator can gain valuable insights to how the company performs and its long-term potential. We can look into Facebook's records to see what they show to open financial market investors. Facebook's income statement shows the company's revenue, costs, and profit for 2012. Note, negative values are shown in parentheses. The difference between its revenue, $5,089 million, and its operating expenses, $4,551 million, is its operating income, $538 million. Most corporations also have interest expenses and income from investments, such as government and corporate bonds. In this case, Facebook paid $44 million more in interest expenses than it earned on its investments. So, its income before taxes was $494 million. After paying taxes of $441 million, Facebook was left with a net income, or accounting profit, of $53 million for the year. Corporations list their assets on the left of their balance sheets and their liabilities on the right. The difference between the value of a firm's assets and the value of its liabilities equals the net worth of the firm, or stockholders' equity. Stockholders' equity is listed on the right side of the balance sheet. Therefore, the value of the left side of the balance sheet must always equal the value of the right side. As we look into the forms and structures of businesses, we started by looking into liability exposure with corporations and limited liability companies providing a firewall for business owners. We transitioned to discussions to detail several required reporting obligations corporations must adhere to. Some people will consider these requirements onerous and financially burdensome to operations. I have been the CEO of corporations where I was the majority shareholder and founder, and one multinational corporation where I was made a super minority shareholder to avoid principal agent problems. The accounting reports for these corporations were more than regulatory requirements. They were performance verifications, strategy-setting standards, and tools used to improve the financial performance. Today, I run an LLC with my wife and one of my daughters as managing members. We are not required to submit the regulatory accounting documentation that corporations are. But we still employ the accounting firm I started using in 1987 to complete the documentation, giving us the ability to grow with targeted intent. I serve on that accounting corporation's board of directors because I know the value of solid accounting records and stock performance. Interestingly, that accounting firm also deploys concepts of determining economic profits discovered using implicit opportunity costs. Really, there is plenty of room on business stages for accountants and economists to work together.